What's up, everybody? Welcome back to Two Guys Talking Houses. Guys, today Mark and I have an excellent episode for you. We're going to get into the 2024 election that just happened and what has happened with both the market in general and the real estate mortgage market since the results have been made final. We're going to talk about the Federal Reserve meeting and the rate cut that just took place. We're going to get into some inventory issues and also talk a little bit about this discussion that Trump has come out with circling privatizing Fannie Mae and Freddie Mac and what that could mean for home buyers and sellers. So without further ado, Mark, let's get into it today. So
Sounds great.
A lot of news this week. So we had an election on Tuesday, in case you didn't know. And
You did? Yeah.
it was only the only thing that anybody's been talking about for the last 3 months.
Right.
I'm just personally glad that all of the text messages and calls I've been getting are going to come to an end, at least hopefully.
Yeah.
But I want to talk about, what has happened since the result has been made clear that Trump is going to be the 47th president of the United States. We saw massive spikes in the stock market. We saw an even bigger spike in the crypto market. However, we saw interest rates for home loans go up, for mortgages go up. And so I'm wondering why in a week where, something happened that was at least seen as positive to the financial markets had somewhat of a negative impact on the mortgage markets. In addition, the fact that rates were cut by 25 basis points, that didn't seem to have much of an effect either. So what's going on this week in the world of mortgages?
Well, there's a couple things going on. So first of all, I don't know if anybody's told you this, but there's a lot of people waiting for the election.
Yeah.
If you ask somebody like, "Hey, you're gonna buy a house now?" No, I'm gonna wait for the election. You're gonna refinance, or I'm gonna wait for the election. You ask your teenager if he's gonna clean his room. I'm gonna wait for the election. I think he's waiting for the next election.
2028,
whatever. And so what happened? The day after the election, a lot of that was the pent up demand, these investors, whether we have an election or not, have an agenda. Like they've got to buy so many good, stable investments. They want to invest in the stock market. So a lot of that happened the day after the election was because of that, because they were kind of waiting around to see what happens, but also to let go of that cash. A lot of people investors were on the sidelines until the election happened. And then once it happened, they executed their original plan anyway.
Sure.
So there was a lot of activity because of that. No matter where you stand politically, a lot of people thought that a Trump presidency was a good thing. And so that, took the stock market up, and to understand why the mortgage market didn't follow, you kind of got to understand why, what drives the mortgage rate market versus what drives everything else.
Right.
The mortgage rate market is I liken it to like a car. If you're shopping for a car and you go to the dealership and there's this, real nice red, sexy Italian sports car, it's a convertible, and you can just see you in Dallas, driving down the road, top down, somewhere not in Houston because you're not dying of heat.
We're not melting with the top down, even in November.
And I mean that's going to sell itself, right?
Sure.
And there's periods of time in your life where that makes sense, and that, let's say that's the stock market.
Okay.
And then you've got, it's not a station wagon anymore. It's an SUV, right? 3-row SUV, sit next to it. And, it's kind of the stable, dependable. You can carry things, take a trip to Home Depot, put your kids in the back. That's sort of the boring, but gets you where you want to go, practical. And that's like mortgage-backed securities.
Okay.
They're an investment that what it's going to give you when you invest your money.
Right.
And now, the Italian sports car, you really don't know what you're going to get, but it looks great.
You could have the ride of your life going 100
yeah.
miles an hour, or you could be broken down calling AAA on the side of the road.
Right. And so that's just it. It's like, people are like, oh, I'm going to make 20% in the stock market if I, invest my money. And so that's an attractive thing. Well, when people do that, then the higher yield mortgage-backed securities sell better. The reason why is because my option is either to go with the Italian sports car, or maybe that SUV is the one with the full leather and Harman Kardon stereo or whatever it is, and it looks super nice. I'm going to take the super nice one as opposed to just the bottom of the barrel.
Sure.
And that kind of governs rates. If we're following the Fannie Mae 5.5, which means nothing to anybody else, now, then that's a higher yield coupon. That means the mortgage rate tied to it is higher.
Right.
And it's all related to how attractive is that. And so when the stock market took off after the election, yeah, that's exactly what happened. Those fixed, boring, your grandmother's investment became a lot less attractive.
So basically, if I understand what you're saying, when the stock market took off, that's the Italian sports car. That was where everybody ran to after the election to put their money there.
A lot of Italian sports cars that day.
Right. So if you want to sell the SUV, meaning if you want to get people into an investment that's a little bit less sexy, less attractive, potentially less upside, but more secure, you do have to increase the payout on that, or what you can expect to earn on an annual basis. So that's why, even given the Fed rate cut of 25 basis points and the election of Trump with the result that happened thereafter with the stock market, we still saw that increase in the mortgage rate. And so my follow-up question to that is, how long can that last, right? Because generally, and you've told me many times that it's not a direct correlation between the federal funds rate and mortgage rates, but it's not that they're completely separated either. I mean, there's some correlation. Generally, when the federal funds rate is low or next to zero, we have low mortgage rates. So right now, what we're seeing is a cut of 25 basis points a couple of months ago, or sorry, a cut of 50 basis points a couple of months ago, now a cut of 25 basis points, and we're still seeing mortgage rates do this. So it's like, my question is, how long can we continue to see rates getting cut and mortgages simultaneously continuing to climb? Or do you think eventually it's going to balance itself out and the mortgage rates will follow the federal funds rate?
Well, right now, got to see what motivates the Federal Reserve, right?
Right.
When they cut rates, they had planned to for quite some time. That this, they told us 4 cuts this year. Actually, we started the year at, I think the number was 6 or 7.
Yeah, I remember that. Yeah.
And then they cut it back to like 2, and then became 4. And the December cut is coming into question. And the reason why is they're watching the data. They're watching jobless claims. How many people are unemployed? Is that increasing? Is that decreasing? Basically, what is the market out there doing? And the comments made, and if you don't know this, when they announced the Federal Reserve's decision, then they also send out the notes from the meeting,
right? And
they make a statement, and every month or every time that changes, every 6 weeks, right? When they come out with a new rate cut, or they stay or increase. And this time was kind of telling, because whereas they were very confident that the job market was softening and easing was the word they used.
Right.
This time, instead of saying easing, it was generally, slowing down, or generally it was kind of, it wasn't quite as strong a statement.
Sure.
And the other thing that, has had people concerned, and this relates to the future, like what's going to happen. Chairman Powell was asked just directly, if President Trump asked you to resign, would you? Yes. And he gave a very one word simple answer: no. and so that just how confident he is in what he's doing. He does intend to remain independent. There's no plan for Trump to get rid of him. Right. So he's going to keep him for however long.
But I think he's there through 2026, right? May of 26.
Yeah, I believe that's the day. So, so that affected things too. It's like, well, okay, are we going to be under this current regime per se, or are we going to have a change there?
And friction likely between the next president and the Fed chairman probably is not the best thing for interest rates or things like that. No. So there's maybe people are anticipating and kind of baking in some friction between Trump and Powell into that into their algorithms and calculations.
Right, and so so the election was Tuesday, Wednesday. Things in the mortgage market that was not a great day.
Yeah.
But yesterday they improved.
How high did rates get on Wednesday, and where did they go on Thursday?
We crossed back over the 7 mark. It was like 7.10 or something like that. And then yesterday we ended back under 7.
Okay.
And so, we always say that rates take the elevator up and the stairs down.
Yes.
And because of that, we didn't see the drop we were hoping yesterday, but that market is continuing to happen today. Now, I'm not going to make a prediction.
Right.
I'm just going to state something that happens almost every time we have a holiday and every time we have a weekend. And that is that in general, on Friday afternoon, on a 3-day weekend like this one, the investors sell out of the market. Like, they don't want to be left holding the bag if something crazy happens over the weekend.
Okay.
And so what we'll see is, they're selling, and the mortgage-backed securities market's going. Because, and when the mortgage-backed securities market does this, then the rates increase. So you're not going to see 1 point difference or something.
Right.
It's probably a quarter, an eighth of a point. So 0.125, 0.25%, between the morning on a Friday and the afternoon. So, typically it'll be, 2 o'clock in the afternoon, 1 o'clock in the afternoon, Central Time, and we'll start to see that. It varies by week, but
I think you may have just given us a mortgage hack. So if you're looking to buy a home and you don't know, there's always that dreaded conversation with the buyer of when should you lock your rate. And some buyers are more risk averse than others, and some are like, I'm happy with where it is right now. I don't want to take the chance of it going up. And some like to roll the dice. But if I can read between the lines a little bit, if you are looking to buy a home and there happens to be a 3-day holiday coming up during that home buying process, it might be smart to lock in Friday afternoon before the beginning of the 3-day holiday.
Well, Friday afternoon it'll be higher. Mortgage rates are higher.
Okay, so Friday morning.
Yeah, so Friday morning as opposed to Friday afternoon in general. Now, there's so many factors that are going to affect that it's not always a reliable prediction, because we've had Fridays where the afternoon is great.
Right.
And we've had Fridays before a holiday. Same deal. Like, oh my gosh, things, it bucked the trend.
Right.
We always say, lock the rate you like. That's a little hard to say lately, because nobody likes the rates, right?
Nobody likes it. But, it's hard to find people that like that.
Maybe it's lock the rate you don't hate. It's probably what we're talking about. But the reality is that a lot of lenders have a float down policy that allows you. Let's say you locked it and it was at 7 and it went to 6.5. Before you're closing. Well, okay, the lenders will let you float down, to a lower rate if the market moves.
Gotcha.
Because it just makes sense. And so a lot of times as a lender, we're encouraging people to lock it right away.
Right.
Now, we have some that like to gamble, and that hasn't paid off. I mean, in the last 6 months, I've not had one person have it pay off yet. And
everybody thinks they can time the market.
Yeah.
Nobody really can.
Yeah, and I mean, they're talking about a difference of $20 a month, which is money, of course. I mean, heck, that's a trip or two to Chick-fil-A these days. So that's a big deal.
Yeah.
And so, but in the grand scheme of things, it's not. It's not hundreds of dollars that we're talking about.
Right. Well, I want to talk about Fannie Mae and Freddie Mac. And, there's been a lot of discussion about the Trump administration privatizing Fannie Mae and Freddie Mac. And, what that could mean from both a lender perspective and a realtor perspective. Mm-hmm. What are your initial thoughts? I mean, obviously, the general rule of thumb is the less government overreach, the better, as far as moving things along and getting, ease of transaction and reducing costs. But I guess let's look at it from both angles. What are some of the positives that could come about privatizing Fannie and Freddie, and what are, in your opinion, some of the negatives?
So we probably should start with how we got here.
Yeah.
So, during the mortgage meltdown, Fannie Mae and Freddie Mac, they make the rules, we'll say, the guidelines for conventional loans. So, they set the debt to income requirements, and they write the rules on your counting rental income, and just all those details are all laid out in a really big book of rules, basically, for lenders. So if you follow these rules, then Fannie Mae will buy your loan. If you don't, then they won't.
Right.
It's pretty much how it works, and then you have to sell it on the scratch and dent market
And that's the
That's not good.
that's a subprime loan essentially, is what.
Well, yeah, I mean, it ends up being a subprime loan, but if you don't follow the rules, exactly, and then Fannie Mae says, I'm not going to buy that loan from you, then you can't really take it subprime. You have to take a scratch and dent, is what they call it.
Really?
Like it's an oops market.
Yeah.
And, you're lucky to get, I don't know, 8 cents on the dollar,
Oh,
7
wow.
cents on the dollar. You're losing money.
Yeah.
So anyway, back in the early 2000s, everybody could buy a house. And it didn't matter. I mean, they had a program called Fast and Easy. If you had I think it was a 680 credit score and 5% down, you didn't have to prove your income. You didn't have to prove what was in the bank. It was just, let's go.
So you could buy $1 million house with good credit and $5,000 or 5%.
5% down. And so then the mortgage meltdown happened. We can talk about why that happened some other time.
Yeah.
Mortgage meltdown happened, and then the government took over conservatorship of Fannie Mae and Freddie Mac. Like, wait a sec, we got to put some brakes on this stuff. We got to put
Some guardrails on this
yeah,
thing. Yeah.
yeah. I mean, we got to put the bumpers in the lanes, on the bowling alley,
Yeah.
to keep that ball from, falling in the gutter every time. And so, that's how we got here.
Okay.
Now, for the most part, a lot of that has righted itself. We're not seeing the mass foreclosures. We're not seeing market crashes like we did in 2008, 9, and 10. And so, taking them out of that conservatorship probably makes some sense.
Right.
It's, I'm not a fan of government oversight. If you allow them to operate independently, they're very smart folks that run those organizations these days. And, I think it'll allow them to respond to the markets and what's going on faster, easier than with the government over. I don't know.
Right.
I don't think we're ever headed to, if you can fog a mirror, you can get a loan.
Sure.
That was basically what we're dealing with in 03, 4, 5, 6.
Yeah.
And but I don't think they're ever
Leading
gonna
right
go
to
there.
the crash, thereafter.
Yeah, I mean, they've learned their lesson that that's not a good idea. And,
Sure.
So, even if they go private, I think it lessens a burden on the government as well, an expense,
Yeah.
and it allows them to, kind of make their own decisions.
And I think that's what makes the most sense. There are certain times where, and I'm not a fan of government overreach either, but there are times where the government does need to step in and say, hey, things have been running kind of amok. Literally our country is littered with foreclosures and banks about to go belly up over,
Right.
this foolishness. So they came in and they did the right thing. But I think there's a certain amount of time where you need oversight. You need that mentoring, tutelage, the watchful eye, so to speak, putting the bumpers up on the bowling lane. And then you start to right the ship. You start to correct the things that led you to the disaster in the first place. And then you no longer need that parent figure sort of helicoptering
Right.
over you. The government doesn't need to spend more money to subsidize this. And so they can get out of Fannie Mae and Freddie Mac feeling more comfortable that they've taken that machine that was broken, given it the tools it needs to fix itself, and now it can kind of operate on its own.
Yeah.
Do you think the privatization of Fannie Mae, Freddie Mac will have an effect at all on the mortgage rates and home prices, or do you think that that's just a totally separate thing?
I don't think it's going to have a real big effect.
Yeah.
I mean, honestly, it's, it's a big effect would be, if they said, hey, you know what, you no longer have to send in your paychecks. We're going to believe you.
Right.
We're not going there, like, ever again.
Because we don't want to have a repeat of the foreclosures.
They know exactly what happened during all that time. And so that was, and there's other rules in place that make sure that can't happen. The
Right.
Consumer Finance Protection Bureau came out, and they came out with all kinds of regulations, the guidelines. They handle enforcement of making sure you're doing the right thing as a lender. And also we've had some other things that have come in place, such as, the disclosure requirements. You can't get to your closing table and find out your rate went from 6% to 8%, for example.
Right.
Like back in the old days, that's how that went. Mortgage, you're signing your mortgage, all of a sudden payment's $400 a month more, and you're like, what? But your moving truck's in the parking lot of the title company.
Right.
And now what do you do? But a lot of that all that regulation is still in place where that kind of stuff can't happen. And so a lot of things that led to the failure of Fannie Mae and Freddie Mac don't exist anymore.
And so I think, it'll be really interesting to see every time we do have a change of power in government, there's some suggestions that are made, and without fail, every time that happens, there's some suggestions that are made with regards to the housing market. So it's going to be very interesting to see, what the Trump presidency brings as far as housing is concerned. Want to move on now to the topic of inventory.
Yes.
We see these rates going back over 7. We see, a change happening in the government. We see some uncertainty with the Fed. We see rates being cut, but federal funds rates being cut, but mortgage rates not following. Even with all that uncertainty, builders are still starting new home builds at an alarming rate. So here in Houston, I think the statistic is just over 13,300 new builds as of October 2024. We're looking at the data that came out last month.
Okay.
Which is, Houston's got more new home builds going on right now than almost any city in the country. And that's a factor of a lot of things. I mean, there's quite a few people post-COVID that are still making their way to Texas and to Florida. And so you see those numbers, very high in those particular states and areas. But to me, it signals that the builders kind of foresee things shaking themselves out. They see the mortgage market correcting. Even if it takes a year or so, we're going to get there, because the last thing a builder wants to do is borrow all this money to build new homes that they then can't sell. And, they're all kind of putting their chips in, so to speak, on the fact that these homes that they're building, and that's what's caused a lot of the home price increase, is just a lack of inventory. You have people at a 2.5%, 3.5% mortgage rate sitting on their house, not wanting to sell because they don't want to go out and get a 7% interest rate. And so that's created, more demand than there is supply. So you have all this pent up buyer demand. And how do you sort of, release the valve on that pressure cooker, is to create more inventory. And then you have more supply to help meet that demand where it is. And so even if the sellers in a traditional resale situation don't want to sell, you have the new builders that are kind of filling that void and getting those people that are on the sidelines trying to get into a home, a place to live. So I think that the builders are going to have, not a very difficult time selling through that inventory. I see the demand. I'm getting calls almost on a daily basis from buyers looking, and I think the people have gotten a little bit accustomed to the rates being higher. I think, back a year ago, they were like, I'm going to wait till they get back to 2.5%, 3%. And then they waited a year, they waited 2 years, and they're like, rates are probably not going back to 2.5%, 3%, maybe ever. Certainly not anytime in the near future. So they're kind of comfortable with it. And, my talking point with a client is, look, forget the rate for a second. Let's look at the down payment. Is that manageable? Let's look at the monthly payment that you're going to have to pay on a monthly basis. That includes your principal, your interest, your taxes, your insurance, HOA, everything. Are you comfortable with that payment? Yeah. And if the answer to those two questions are yes, then buy the house, because you can always refinance down the road. So just want to get your thoughts on the increase in new builds and what you think. Do you think the builders are going to have trouble selling through that inventory, or do you think there's going to be enough demand to fill it?
So, I've been at this a long time, and Houston is kind of a different market. Whereas, our new construction builds, permits, and everything else are up. That's not always the case nationwide.
Right.
And in fact, because of the federal funds rate being high, which we talked about, in a previous episode about federal funds rates high, it costs banks more to get the money to lend businesses to do, like builders, to build houses, right?
Yeah.
And so that stifles some of that activity because it costs so much, right?
Right.
And as rates come down, that should get better, right? But here in Houston, I think the only year we've ever seen a decrease in value was in 1983.
Is that right?
Oil crash, and I mean, it's just, maybe that appreciation's only been 1% that year, but it wasn't zero, and it certainly wasn't a drop like it was in other markets, and while we have more inventory here, if you go to Connecticut or Maine or New York or the West Coast, that's not the case. There's not a lot of there's not a lot of inventory out there, and the fear in the market, just kind of to bring it all together, the fear in the market is that a lot of people think about 6%, or when we get under 6%, the market's going to go nuts. Like all that pent up demand, like the election's out of the way, right? And so when that happens, we don't have enough inventory. There's not enough houses to buy,
Right.
and there were some of those people waiting for 2 and 3%. But I was reading this week, back in 2020, they were buying like $700 billion worth of mortgage-backed securities. And when you've got that built-in demand, I mean, who cares what it yields, right?
Right.
So and that's what caused those lower rates. Well, the Federal Reserve can't continue to put it on their books and maintain it. And in fact, they're getting rid of it.
Right.
They're getting their balance sheet down every month. And so, we'll see a drop in rates. Never going to see 2 and 3% again. Probably not in our lifetime. Unless there's maybe another global pandemic creating that situation.
Right, sure, yeah. You forget what comes with what happened to get those 2.5-3% rates was a nationwide or worldwide shutdown and global pandemic. So let's I'd rather see rates in a reasonable 4 or 5% than to deal with that again.
Yeah, one of the things I was listening to a podcast the other day about kind of the housing market, new construction specifically. And, while they're not building as many houses, they're not laying off the construction workers.
Right.
Yeah, they're kind of maintaining that. As long as that keeps going, then, we're in good shape. Housing is such a huge part of the economy.
Yeah.
Right? That, if the market slows down too much and they can't sell those houses, that becomes a problem.
Sure.
So the builders are in a constant keep the machine running mentality. They have to offer buy rates or buy a bunch of mortgages at 4.5% or whatever to do it. Then they're going to do that.
Right. Sure.
And so they're kind of maintaining. We'll see what brings next, or what next year brings. So and maybe we should talk about that for a second.
Yeah.
Because we talked about the Trump presidency, the election, all of that demand. But there's a lurking concern. So the lurking concern in the market is that Trump is going to put in place all those tariffs again that he's talked about for different countries, and he's going to drive inflation.
Right.
The great thing about the Trump presidency is we have a preview.
Sure.
We have when he was president 4 years, 4 years ago.
Back, yeah.
Yeah. So we can say, oh, that's what he did that time, and it's very similar. He's not going to, take office and the very next day slap, 100% tariffs on Mexico and wherever.
Right.
It just doesn't make sense. No, he's got a lot of other things he's going to do. Take care of some tax cuts and do all kinds of other things before. And if we look back at his previous, those tariffs didn't start taking place till about the second year or the third year of his presidency.
Yeah.
And so, a lot of those concerns, I don't want to say they're unfounded, but it's not as big a deal as I think people are making of it.
Yeah.
And so, that's going to relate to the federal funds rate. That's going to relate to housing market. That's going to relate to so many factors out there. And because the goal again, the Federal Reserve is keep inflation under 2%. This time they said it's generally trending towards 2%.
Yeah.
Instead of saying it's on a path,
Right,
the language is a little different this time. And to keep the unemployment rate from getting out of sight.
And I think that's a really great point. And I was listening to a podcast as well where Elon Musk was on it, and he was talking about the tariffs. It's very likely that Elon's going to have some pretty major involvement in the Trump administration.
Yeah.
And, almost more so than anybody, he has a really unique look into what tariffs can do as far as international trade, because he's getting the batteries for the Teslas from here, and this component for the computer chip from there, and the tires come from the United States, but this part of it comes from that country. And so, when you look at a Tesla or, SpaceX, a rocket that's landing itself, which is really an incredible feat, and some of the other things that Musk is working on, he kind of has a real understanding of what international trade needs to look like to get that Tesla in your driveway, or get that rocket launched into space and have it return back to the landing platform. So he was saying that, he's a big fan of a lot of the economic policy that Trump has discussed thus far. The only thing he's concerned about is the tariffs, and he plans to advise him on how to best go about that. So I don't think that Trump is going to just, flip the switch without careful consideration, because you will do things that inadvertently you're trying to create tariffs on countries that we want to garner money from, but you also can hurt companies that exist within your country already. So balancing that, I think, is going to be really important. I think Elon's going to play a big role in that. And as you said, I don't think he's going to come in day one and just start hitting, the other countries with massive tariffs that cause these, this inflation. I think Trump sees the overall inflation rate going down and the overall mortgage rate eventually finding itself trending down a little bit, both being really positive things for his presidency. And I think he's going to try to utilize some tactics and some strategies and some legislation that gets that goal achieved.
Yeah, I mean, you got to think. I mean, you can't change the course of the Mayflower too fast.
No.
Or the Pilgrims all fall off.
Exactly.
Go overboard.
Yeah.
And so, to not lose the Pilgrims, he can't just all of a sudden go, we're going to do this today.
Right.
It takes a long time, and he's got to have the cooperation of Congress.
Right.
Whereas the Senate is definitely a majority Republican. The House of Representatives is not, solidly. It is a majority, and we've still got some races out there, I think, that still aren't determined.
Right.
There's some other things going on. So, but whatever. And so, point is that it would be really hard for him to come in and go, well, we're just going to do this, that, blah blah blah. He'll do some things, and keep in mind, it's we're talking about this in November.
Right. Exactly. Yeah.
He has to take over till January.
Right. And that's a great point. Yeah, none of this can even be implemented for another 2 months, and then how long thereafter will it take for things to change? I think that's
to filter through.
A really good thing to consider, and I think that's a perfect place to leave it for the day. Did you have anything else?
No, I mean, I'm excited about 25. 2025. I think I think we're going to see some demand in the market increase and rates decrease at the same time. It's going to be a good year. We're looking forward to it.
Absolutely.
Making now a great time to buy a house.
Yeah, and just anecdotally speaking, because I'm one of one, I'm not a large sample size. My phone in the second half of 2024, and even more so now in October, November, is ringing a lot more often than it did in the first part of the year. And it's not that mortgage rates are lower than they were in the first part of the year, but that indicates to me that there's something else going on where people are feeling comfortability to want to make that call and say, hey, Stephen, I'm ready to list this house, or hey, Stephen, I'm looking to buy my first house and I feel like now's the right time. So, as you say it all the time when you come and talk to our real estate team, what can you do given all this information? And this actually is for you real estate agents out there and you loan officers out there. The phone works whether rates are at 2% or rates are at 7%. Pick up that phone and make a call. Call your database. And
right.
Mark, I think you say that beautifully when you come and coach to our team, because there's always a lot of fear in the market. If you're an agent, you're in this business and you live and die by the commissions, you know what?
Right.
Pick up the phone and make some calls. You'll be surprised where it can lead you.
Yeah, the choices you make now make the choices you have later on in life possible.
There you go.
Say that to my children a lot. They don't love that phrase, but it applies here. If you're in the real estate industry, then absolutely, you need to make those calls, keep those contacts, don't go hide under a rock. And if you're in the market to buy a house, again, I mean, you're waiting for what? You're waiting for higher prices.
Exactly.
That's almost guaranteed.
Right.
You're waiting for lower rates. You can go fix that later.
Exactly.
With a refinance. And if God forbid rates go up for some reason, you're protected. You're locked in at 6.5 or whatever it is, and you're not going to 7 or whatever. But if it goes to 5, something in the 5s, then yeah, it makes sense to refinance. Let's go do that. But,
absolutely.
Yeah.
Well, guys, thanks so much for watching this episode. Mark and I are super curious. How do you think the results of the 2024 election will affect the real estate and mortgage markets? Drop your comments down below. We'd love to engage with you and comment there. If you want to get in touch with either myself or Mark, we have QR codes in the banner on our YouTube page. We'll put a link in the description of how to best get in contact with each of us. And if you're looking to buy or sell in the Houston area, we'd love to help. We also have a massive referral network throughout the country, so get in touch with us and we will take care of you. Until next time, have a great day.